Stream is live.
All right, so we are live. Sorry, it's a couple minutes late. Had some technical difficulties. So I will have Cheetah introduce us first while I get some things going.
I'll give you a moment to get settled. Hello, everyone. Welcome to our first time homebuyer seminar. I just want to say thank you for taking time out of your schedule to join us this morning to learn about the housing market and, how to buy your first home. My name is Cheetah Metcalf. I am a mortgage broker. I've been a mortgage broker since 2010. So doing the math, that's 16 years. My previous career was a teacher. And so education is a huge part of our industry. That's why Kathy and I are doing this. And so I still get to use my teaching degree in my career.
Okay, and I am a realtor with Real Broker. I've been licensed since 2010, so in my 17th year as a realtor, and my husband and I also own a real estate appraisal company, and that is probably entering, its 20th year. So yes, we have a lot of knowledge to share with our combined over 30 years, probably reaching 35, 40 years of experience here. So if you haven't already done so, it would be really nice if you, let me get my screens here, let us know, go to this QR code and let us know what you were hoping to learn today. It's just a quick, a minute, 2-minute survey, just so that we know what to focus more time on. And I will give you a few minutes to go to this link. Okay, so we've got a lot of information to go through today. And so what we're going to do is we're going to start with the outline of what you can expect today. So we're going to talk about the pros and cons of renting versus owning. And obviously we're going to go do some numbers crunching, some finances. Cheetah will go through the credits and what that means in terms of your how much mortgage you might be able to qualify for, and what type of savings you might get if you had a higher score versus a lower score. There's also a bunch of programs that the government has provided us to help us get into our first home. And then the process of getting your mortgage approval. And then I will go through the process of finding your home and what to expect on closing day. Okay, so let's get started. Renting versus home owning. So the true cost of it, obviously when you're renting, you're kind of just giving money away. Every month you're just giving it to your landlord for them to pay down their home. So You're building somebody else's equity. There is no accumulation for you at the end of the day. Rents since 2021 rose about 28%. You don't get any tax deductions for renters, and a landlord could sell or redevelop the property at any time. So at the end of your lease, you really have no certainty as to whether you can stay or not. And you lose the ability to be able to personalize your home. I know that with some of my rental properties, I've been asked, oh, can I put up a shelf? Can I do this? I'm like, unless you have to poke holes in the walls, please do not. And I also don't allow them to paint. So you lose all that ability and then you have no security. Now, on the flip side over here, the math over a average 5-year term, for a 2 to 3 bedroom rental, you're on average paying anywhere from $1,800 to $2,200 a month. Your annual rent is upwards of $25,000. You're in 5 years, that's over $126,000, and you've got $0 built up in your bank account. Whereas a homeowner would have some equity pay down and have a little nest egg there. So after 5 years of renting, zero wealth created. So why owning wins long term in Alberta? You benefit from the equity growth. Okay, so as the home appreciates year after year, you're benefiting from that without doing anything. Okay, you've got payment certainty. So whether you're locked into a 3 to 5 year mortgage, it's going to be, your payments are going to be exactly the same every month for those 3 to 5 years until renewal. The tax advantages that we'll be talking about that Cheetah will be going through in a bit here. And the freedom to customize your home, like I said, freedom to make the home better and build some sweat equity. And it's also a forced savings account. So every payment that you make, a portion of it goes to interest, so goes to the bank, but a small portion of it will also pay down your mortgage, which is your forced savings account. Okay. And then the advantage of buying in Alberta is that we have no land transfer tax, as opposed to areas like in BC and Ontario, where you could spend an extra $5,000 to $15,000 on land transfer tax when you purchase a home. Okay. So over a 10-year term, the blue line is a homeowner and the yellow line is a renter. So there's not much wealth that you can build up as a renter because you're just giving rent to your landlord every month. Okay, so let's talk about the financial preparation, and I'll hand it over to Cheetah.
Thank you, Kathy. So now that you see the benefits of buying versus renting, so you probably want to get started into the process of looking or getting prepared. I wanted to, before this, so we are on the credits score slide, but I want to explain what is the difference between myself, a mortgage broker, versus a banker. Many of you probably have an account with an existing financial institution. In Canada, there's a top 5 banks. We call them the colors. You got the blue BMO, you got the red Scotia, right, in RBC. So you do have the ability to walk into a branch, sit down with the bank person, run the application. They will tell you their rates, their products, and you can go through that pre-approval stage, that pre-qualifying stage with the banker, but you don't quite know whether that rate that they're providing you, what products they're providing you, without being able to compare. So in the past, you would then have to book an appointment with the bank across the street and then do the same process. You're doing 2 credit checks, 2 appointments. and then listening to that banker tell you about their rate and products. So that's one old archaic way, time consuming, multiple credit pulls. You can do that route, or the other route is you deal with the mortgage broker. Like myself, I'm an independent. I work for my company, TMG, my brokerage. My brokerage has a contract with all those banks and lenders, Service, ATB, Scotiabank, TD, BMO. So you come and meet me. I do the same process as that banker. We do the credit check, the due diligence, but rather than you having to go shop and do multiple credit pulls and the legwork, I'm the one that does the shopping for you because I have access to all the different lenders. So that's the one. It's the one, meet one person, do all the due diligence, shop all the lenders. Using a mortgage broker is free. There's no cost to consumers, to you, to use a mortgage broker because the lenders compensate me. So I do all that work for you. And so those are the benefits of using a mortgage broker. And not to mention, I don't adhere to bank hours. So you are able to get a hold of me on evenings, weekends. Mortgage broker and realtor relationships typically are strong in the fact that we understand your realtors are negotiating at 9, 10 p.m. on a Friday night. And if they need an answer, there's something time sensitive, you're not calling your banker. You're calling the broker who typically with good relationships. Kathy can call me at any time and say, Cheetah, I need something right now. I've got something. It's something in the fire. We need some numbers before we can pull the plug. And I'm happy to do so. So because of that flexibility or the mortgage broker's autonomy, we're able to have that strength over the banker. So that's the difference between a mortgage broker or going into the bank. So nowadays we're starting to see a lot. The realtors refer the mortgage brokers because they know there's a different option, and so but they understand the benefits of using a broker versus banker. So we'll go into this credit score. Can you do me a favor, Kathy? Can you please go back to the previous slide? There's something on here. It says so. Yeah. So
Here?
Next one, the financial preparation slide. Thank you. So the preparation is when you look into the three pillars, the actual three pillars is credit, savings, and down payment. That's the same. And the last one, the third pillar, is actually income. So we'll should have revised this slide, but the three pillars is income, savings, down payment, and then credit. Those are the three things that we look at when your mortgage broker is doing the initial contact with you to go through what you qualify for. Because when you meet with the mortgage broker, what you're trying to come out with is, what's my budget? And do I have what the lender needs in order for me to get approved for a mortgage? So we do all the pre stuff, which is called the pre-approval beforehand, but we can look at those three pillars. First pillar, credit score. Everyone who has a SIN number in Canada will have a credit score. And that's if you borrowed any kind of credit. So you have a cell phone bill, you would have a credit score. Even if you don't have a credit card, the second you have a cell phone under your name, it's registered on a credit bureau. So everyone, depending on how you handle your credit, there's two reporting agencies in Canada. There's Equifax and TransUnion. Equifax is the one that we mainly use. TransUnion is a secondary that some lenders pull additional. But depending on how you manage your credit, you are given a score. So based on this slide here, you're going to notice the different levels of options of lending. And when we say different lending, these scores will reflect your types of lending and the interest rate that you're going to be paying. So it's a reward system for good credit, management, and a punishment for if you're not. But do understand a credit score is a fluid number that changes with good repayment history. So there is ability for anyone who has poor credit for whatever reason, life happens, divorce, death in fountains, anything can happen. Just know there is life after, a tragic or an incident that has bruised your credit. So if you continue, you can rebuild credit. And just as easily, when you have good credit, you can lose that status by if you're being neglectful and not paying your debt and overspending and being careless. But the credit history, a lender's looking at this as a reflection of How are you managing your existing credit, whether it's a credit card, line of credit, vehicle payment? We'll let them know if you'll be able to manage hundreds of thousands of dollars borrowed to buy a house. So it's this insight into how good you are to be able to manage one of the biggest debts of your life. So that's one. And credit education is something a mortgage broker, education number, but credit education is something a mortgage broker spends extensive time with if you feel that you need some education on or some hand holding. At this point, this slide will show you the amounts and the interest rates and how they affect your payment. Because the higher your interest rate, the same mortgage amount will have a higher payment because more of that goes to interest costs. That's how that affects your payment, the higher interest rate. And that will be that's on the bottom. Okay, next slide, please. Boost your credit. So let's see what the credit algorithm, Equifax credit algorithm, because Equifax, it's when it takes in your payment history, imagine it's just a bot. It's just a computer. The algorithm says, hey, if they're, if they miss a payment on one of their credits, it's going to drop by this score. And so as every single month you're doing you're paying on time or you're not paying on time, it is computing into the computer system and creating that score for you. So the things you want to do, what it's looking for. So 35% is, are you making your credit card minimum payment on time? Bills and credit cards, loans, is it on time? And if you're not paying on time, it shows specifically on your credit if it's 30, 60, 90 days late. It will show. So it's a pretty extensive, very, very extensive report. So make sure you only need to make the minimum payment. And that is ideal. Do not miss the minimum payment. And even if the balance is very low and the minimum payment is $5, do not miss that. That algorithm triggers missed payment. It's not saying that it's a very small payment. It's not measuring that. It's you're not paying on time. That behavior. Keeping credit card balance under 30%. The credit card balance is very important. And I can say, hey, go up to 50%. And there is some room there. The no-nos, the absolute no-nos, you do not go over limit. That is when the credit algorithm punishes you severely. When your balance and limit goes over. And I know credit card companies, they'll let you go over, but that on your credit score, you're overextended. Don't close any old accounts. Please don't. So this is something that we are looking for, the length of history. The longer you have a credit, and whether you're using the account or not, there's no need to close it down. You can have a balance of zero. It's the ones that you don't, I know lots of credit card companies, especially the ones with points and they, those have an annual fee. So those ones, definitely use those ones because you want to get the points because you're paying the annual fees for those. But for the ones that don't have fees, keep those, because the history that you have, even if you're not using it, that history happens because we see on the credit bureau, when you've opened it, we show how many times you've used it, how many repayments into it, right? And again, that start date, we look at the start date. When did that credit trade, we say credit open? So that's very important. There's no need to close it down. If you do need to close it down, just make sure there's we try to ask for two credit cards, 2 credit products, whether it's a line of credit card, so the revolving credit. So we're talking about the lines of credit cards. Loan payments are static payments. So just like if anyone has a car loan, you're paying down, you're not able to re-advance it, right? So those are loan static pay down. What gives the lenders the best view of your credit worthiness is revolving credits. It's lines of credits and credit cards. So we want to see 2 of those with the limit of at least $2,500 limit, at least. It's difficult, right? It's not that, with a $500 limit credit card, you can't really get into too much trouble for $500. But if you have $2,500, the lender can see that there's a higher amount. You can run into from some like $2,500 it's a sizable amount that you can run into difficulty with. So that's advisable. This dispute errors on the Equifax. Like I said, Equifax Bureau is just it's data collecting. So anyone keying, you're applying for a credit card, some human keying in a name, there's a misspelling of name, there's a date of birth kind of disconnect. So that shows up on your Equifax bureau. Generally speaking, it's not going to unfoil your application, but sometimes someone has a common name, and next thing you know, on their credit bureau is someone else's. They have a credit card that's not theirs, and so it's just, again, it's a computer. You may have picked up someone else's credit card, and they're mismanaging their payment. It's tanking your score. So checking Equifax and getting that disputed and corrected will help. Well, it needs to be corrected, because by the time it gets to the lender, they want to make sure that is not, that wasn't you, and that was dealt with beforehand. So the pre-approval stage, when you're talking to the mortgage broker, credit check, and we will do that to make sure everything's clean. And if we have to remediate anything, we can do that before the pre-approval stage, before I send you shopping. That's why it's very important to be pre-approved, because those are surprises that sometimes the clients don't even know about. And avoid new credit 6 months before applying. If you have a strong credit score and there's no need to apply for new credit, then don't. Like, it's healthy enough, don't. And if you're trying to, and we always say, don't incur more debt before you want to buy a big house or a house. That is not ideal. What you have is a liability. How we qualify for a mortgage is take your income, household income, minus all the liabilities or the debt, the obligations you have, credit card balances, vehicle payments, minus that. And whatever's left over is what you qualify for a mortgage. So as you're taking on more debt, you're reducing the amount of income left over in your application to get the size of house. So when I have clients come to me and say, well, we just went and bought a couple of vehicles and we want to buy a house. Well, I already know off the top of my head, I've got 2 payments that I have to take away from the income. So you're going to have less to qualify for had you waited. So that is another thing too. Before you start making some big purchases, talk to the mortgage broker about your plans. Next.
Wait till I give you keys to your new house before you go and buy those big purchases. Cheetah, I've got 2 questions here from Hannah. She just added a new credit card, and it's been paid off perfectly every time. Okay. And she's wondering, those 2 cards are they added together into one score, even though it's 2 different banks?
Yes. So the report itself will take all your credit products from different institutions, all your institutions, whether if your car loans with the Scotiabank, your credit cards with TD, you go PC. They're always handing out cards at PC. There's Costco. It's all combined in your one credit report, and your one score. Your one score is reflective of how you manage all of those together, combined. Does that answer the question?
Okay. I think so. It's just one score. It's not multiple scores for each credit
product,
credit card or loan. Okay, it's just one score combined.
Yeah, so there is one score, but understand that one credit product affects that score. So you miss a payment on that one credit product, that score is going to take a hit, right? So that's why it's all a combined management of every single one of them that now adds up to your score. Every one of them affects it negatively and positively.
Okay, and the other question is, one person has good credit and the other one is just rebuilding. How does that affect the application?
So what we would do is, in order to be on the application, everyone has to be top notch. And so we would look at, if that person who is rebuilding credit, can we do the mortgage application with just the person has good credit? Because the good credit is what gets your entry into being on the application. So if someone's rebuilding their bankruptcy and doesn't quite qualify, we say, hey, can we keep them off the application? Do the qualification on the one person that has the credit. Does their income based on that one person be able to qualify? And if they do, we'll proceed to the next step. If we need this person who's rebuilding credit, we need their income to service the size of the mortgage that we need to get, then we will have to work on rebuilding that person's credit. So then they'll be able to be on the application for me to allow to be using the, the income to be able to support a larger or the size of home that we need. So we can put someone on the application and we can put them off for what various reasons, and credit issues have been a very common reason to remove someone off of the credit, so come off of the mortgage, and then we can add them on after when they've cleaned up or they've rebuilt credit.
Yeah, I think another option would be to see if there's some, like, family member that could
Co-sign.
also be co-signing. Yeah.
To remove one, co-sign, swap after. Those are definitely options that are also available for someone who is still working on rebuilding, or you just plan to wait. And so there is the requirement for rebuilding after bankruptcy is 2 years. So discharged, rebuilt credit for 2 years, 2 trade lines. So that's where it's like, yeah, there's life after bankruptcy. So lenders have, they're outlined in their policy and what they need to see on credit to be able to use that person on the application, and be able to use their income and qualify again. Yes. When you co-sign, then we use so the co-signer just works like another applicant. So we take their income, their credit, so their credit, their income. So co-signers, typically that's very common, is parents will co-sign for their young adult children. And so we would take the parents' income, whatever liabilities. If parents have still have a mortgage, they have their car payments, we remove the liabilities, and whatever is left over, do they have the additional income to add on to my application? The application can go up to 4 people. I can take 4 people on the application, all their income, all their debt, so that I can calculate what do we have left over to be able to qualify for the mortgage. It's all a mathematical process, but we can definitely use the cosigner's income. That's one of the main reasons to bring a cosigner on is income, credit remediation and income.
Yeah. And first thing you want to do if you're in the situation is to talk to Cheetah so that she can make custom recommendations on how to build your credit the fastest way.
Custom plan. Yeah, we custom build a plan. I will send you, we'll have a conversation, pull your credit, see where we are with the credit, what it's reporting, and then set a plan. So this right now, products that it's all paid out. This is what the lender needs to see. And so I'll give you some suggestions of which lenders or banks that you can start to go to who can more easily give you a credit card to rebuild credit.
Okay. Moving on to the Alberta programs to help us create our down payment.
Yes. So the down payments can come from 3 sources. Your normal, just saving up in your bank account. The second one is investment accounts. These are government programs in order to help Canadians, first-time home buyers, get into a home. We'll go deeper into these, but right now it's just a general, just 3 products are, savings account, investment. And then the third one's a gift from bank of mom and dad, but familial relationship work. So aunts, uncles, grandma, grandpa, right? You might get an early inheritance. So you can get gifted down payment as well. And so mortgages in Canada is highly, highly regulated because the housing market is a large part of our economy, but there's strict governance of what you can use in the source of the down payment. So prepping where the down payment comes from is very important. And I just had to deal with the file we had to sell some gold. So it is very important, strictly regulated at what kind of money and how it's put into account for the down payment of your home. So those are the 3 sources. Yeah. But talk to me first. If you have unconventional money, like I said, I've got gold bars. Okay. Right. So let's have a discussion before we send you shopping.
Yeah. As professionals, we actually have to ask you where your source of down payment is coming from. So it's a FinTrack form. So we have to be like, okay, what account did it come from? And Cheetah will make sure that money has been there, for a few months or at least a month
90
before.
days when it seeds in the account. It needs to seed in the account for 90 days for it to be considered own funds. Gift, it's different, but and the gift is gift letter signed. It has to be signed off. It's a true gift. The money seeds in the account for 90 days if it's a savings account, and any large deposits within those 90 days needs to be sourced. So it can go down a rabbit hole, especially if many people have multiple accounts. So it's not common. It's more common that people have more than one account these days, because before most people just have one bank, one institution, an investment account with one institution. Whereas now you have various accounts. You have investment accounts through Questrade, Wealthsimple. Then some people have the online accounts versus the brick mortar by banks. So there's many accounts, in the movement of that money within that 90 days. We need to follow paper trail, or just clean it up and say, hey, let's not move the money, and this is how we're preparing you for success. So let's get right into the programs. The most powerful program, and this is something that anyone looking to buy a house, this is the program that you should just go and open. There's no minimum to open. There's no minimum, but you should put some money in there. And it starts to grow, like the room for contribution grows from the day you open that account. So if you end up waiting, I don't know, saving your money in your, let's say, you started waiting maybe 2-3 years, because you're allowed to put $8 grand every single year. You are in somehow, I don't know, you get $16,000. You only can do that first year at $8,000 if you just open that account right away. If you'd opened it a couple of years ago, put a little bit of money, in a couple of years, you're allowed $16,000. You can put in all $16,000 because you opened it a couple of years ago and you have 2 years worth of room. So it's a great idea to use. It's a product. So you open the account, you have to use it within 15 years. So if you have plans to buy a home within 15 years, it's a good idea. And it's the strongest, powerful tool, because the money going in has the benefit of saving you on your taxes. And then the growth itself is tax-free. So that product, if anyone has an RSP and a TFSA, can understand that's just the confusion of both. But those who don't, to explain why an RRSP, a retirement savings plan, is a very powerful tool, is the fact that for example, let's say you make $50,000 a year, you put $5,000 into your RSP, you pay taxes for $50,000. But because now that you put $5,000 to RRSP on your tax return that year, you're deducted that $5,000 from your income. So now it's showing that it's taxable income now is $45,000, and the tax that you paid on $50,000, that $5,000 difference, you get back. So there are money that you can get back, and you can reinvest it into your RSP, or you can use it for something else. But that's where the tax savings comes from. It's a deduction off of your income, and you get that tax that you paid for the full income. So that's the RSP benefit. And then with the first time home buyer benefit, it's not tax free. Like, it's you using after tax income, but the growth itself is tax free. The RSP, want to go back, the RSP, the reason why it's tax-free going in, because when you actually deduct, you bring it out for retirement down the road, you're taxed down the road. You're not taxed money going in, but the government will get you on its way back out. So you're gonna pay the government one way or another, but you're not paying going in, you're paying coming out. TFSA, the opposite, that's the opposite, where it's after taxes, but your growth is tax-free. So it's free. It's no tax coming out. Whereas the first home savings account, the one that's the most powerful tool, gets the benefit of those both. And you have one time to use it. Buy your first home. Once you owned a home, so this is where do not co-sign. If you have a first home savings account and you're being asked to co-sign, You're not allowed to own a home, be entitled of a home, because you're only allowed to use it once. And once one time you're eligible, build it up, use it once, that product's now gone. You are no longer eligible. It's a powerful tool. Get it when you can, because once you no longer qualify to be a first-time home buyer, it is not a product you can able to contribute or use. So I think I kind of perused over. So this slide here, I've kind of gone over the gist of the different types of products, but I'll quickly go over where first home saving account, 8,000 a year, lifetime limit 40 grand per person. Couples, it's you can only open it separately. Husband and wife or partners, it's not a joint account. You open one separately, and when you come on the mortgage title, then you can pull from individuals. The tax benefit, because taxes are done individually. Now, it's a couple individual. That's the reason why it's done individually. So the tax goes in and out, unused room carries forward, open now. RSP, you can withdraw 60 grand from your RSP for the home buyer plan. So not retirement. This is also a time that you can pull out tax-free. And so you can go each 60, so 120 total, but you have to repay that back. And if you don't, every single year it's broken down where you are taxed on that money that you pulled out if you hadn't paid it back. So it's this, you're still expected to recontribute back if you pulled out for the home buyer's plan. Okay. And in this instance, so RSP, it has to be in its seed in the account for the 90 days. It has to be in that account for 90 days. It can be combined with your FHSA. So you can actually stack all of these products together, take money out from all of these to be able to use a down payment. So you can max out your first time home buyers, FHSA, then your HP plan. So you can, whatever contribution rooms that you have, you can go and max those out and then withdraw those for your down payment. And first time home buyers account. So this is where, the tax credit. This is a tax credit. The tax credit is something your accountant will do. So this product is, you have the ability to get, it applies to your tax return, and you can get up to $1,500. It's something you don't need to do, but you have to just let you know, do with your accountant when you're filing your year, that year that you bought your home. Let your accountant know you bought a home, and your accountant would know to apply this tax credit to your tax, so you could get a credit refund. I think next slide.
We have a question. How do I open an FHSA account?
Yes, so you can definitely do about 1 to 2. Yeah, so there's no minimum. You can go, so there's your bank, and so all the big 5 banks in Canada, all of them can. I have to double check if you can do a Wealthsimple or Quest Trade. I think you can, because I know you can open an RESP, you can open an investment account, but your bank 100% can. But if you already have an account with, if you're already investing with Wealthsimple and have those other products, there should be a way to see if you open up, like if you can open an account. But I know definitely go into your bank if you have a bank relationship. Go, every single bank now has an FHSA. You can go and open one up and put as little as possible, just so that you can start opening up that room.
So question for me, I guess, with a follow-up on that, if I open an FHSA with a bank, can I go to another bank to open up another account?
It's a relatively new, so this is the thing, it's a relatively new program, like a couple, right?
Few years, yeah.
Couple years. I have not, all of my clients who I've had to use the FHSA have used just one. It's been a one account. But that being said, I don't see a reason why not, because I know a lot of people prefer the autonomy of dealing with doing their own self-directed investing versus going to a bank, and now you're dealing with someone. So I don't see why not. I think so. You're given your slip, your T-slip for filing taxes every single year. So it does get, so you'll get those slips from different financial institutions. I don't see a reason why not. Thank you. That's a great question. We'll table that. I will definitely do some more research. So in my own personal experience, it has only been one account, but I'll double check. If I had to make an educated guess, it would be, you can. You can.
Mhm. Okay.
You have to
Next
watch
slide here.
contributions like with the TFSA. Correct. You have to make sure that you're not correct. So when you're contributing that year and you're just making some, and I know this is where if you're, because my stuff, like my investments are self-directed. So I can see my contribution. It shows me my contribution room as I'm moving money. It shows me what my contribution room is and what I have left. And so if I start realizing that I'm, if I'm thinking I've moved money, right? I can see whether I'm breaching my contribution room. So yeah, I know that's why I don't deal with the banks itself. It doesn't give me the ability to right away see what because I'm not making those, I'm not making those moves. Often when you're dealing with the banker, maybe if you want to do kind of like give, set, and forget, that banker or the investment advisor will be knowledge, like will know, like if you want to add more money, because every time you want to, you're going to call them that you're breaching it, right? So before you breach it, they should let you know. Whereas I know with my investment account, it already, I can see how much contribution room, and I shouldn't go over that year. If I open one up that it comes to tax time, what do I have to do? So whoever does your taxes, often whoever does your taxes, I have my accountant. My accountant, I give him all my slips for when I'm doing my tax filing. So that will have all my accounting slips and whatnot. And I know that times that he can pull it up on the CRA system as well. The T slips are from employers or given to the government. So it's all online, their systems. Accountants have systems with CRA that they can see. They can already see. So I don't know if H&R Block, because I don't use H&R Block, if anyone uses those firms, but my specific accountant, I give him all my slips, and it seems like he already knows that, these are coming.
I think just like pretend it's like an RSP. Like if you went into your online banking, you should be able to see how much you've contributed and all that stuff. So, yeah, I would just make sure that you have online banking on there, and you should be able to look at that. Or if you just set it at $500 a month, you should know that you wouldn't go over.
Exactly. And often, even if my stuff is self-directed, not many people are moving funds around. When you're investing, you're not supposed to be buying, selling. You're not a day trader. Like I'm not a day trader. And so often I know, right, the few times I do contribute and I'm buying, I know how much I'm putting in, and I'm not, and I'm some at times like I'm not near my contribution room. So it's not something that you can just accidentally do. Like I feel like people aren't moving around money often enough that they accidentally go over. So it's not something that needs to be like monitored strictly. So oftentimes, like if you're going to open up your 1 to 2K, you're going to start opening that up. And some people, you will set up an automatic withdrawal from your account every single month. And so that automatic withdrawal, if that's all you contribute, you're not going over. Right. So yeah, it's not something that it's not a complaint I hear often or ever that they've got.
These are really great questions.
Thank
So
you.
keep them coming. But we do have to move on. For those of you that may have to leave at the top of the hour, this will be here for you on YouTube so that you can jump back in where you left off if you have to leave early, because we're running a little bit behind, but we want to make sure that we do get all your questions answered. So thank you.
Great
and
question.
Let's keep going.
Yes, and understand. So Kathy and myself, we're not, for you to call us and ask us specific questions pertaining to you. Our time is not, we're not billing hours. We're not billing time. Call us. Conversations with us on the phone are not charged. This is all education. We either do this presenting to you now, or it's a phone call. Book a call with us. We'd love to discuss your specific requirements and situation. And think that intimate call itself can build that customizable plan for you. Okay, so some of this stuff is like, let's delve into like a very specific for you, but we'll continue move on so we can keep the broad and general information. But great questions. So continue on. First time home, the rebate. So this is if you're buying a brand new house. So again, other programs the government has rolled out. The mandate is to try to get homeowners, housing starts, so Canadians into homes. So there's a GSP rebate you can apply if you're buying a new build versus a resale. And 30-year amortization, a 30-year amortization. So we used to have maximum 25. As a first-time home buyer, you're now allowed to go up to 30 years. This is something that you don't need to choose. It's just the mortgage broker, when we're doing your application, will say, hey, you have the opportunity to do 25 years or 30 years. And the 25, the allowance to extend the amortization, imagine taking a $450,000 mortgage that we have an example here and stretching it over a longer period of time. So the difference is if you keep it over 25 years, the payment will be higher because you have less time to pay it off. You need to pay more off quickly. Whereas if you extend it out to 30 years, we added another 5 years of payment, which ends up being $200, $400 a month. In our specific $450,000 mortgage example, we've used, so that's an extra $250, almost $250 a month. By that little gap, you can get, so on my example here, on a $450,000 mortgage, the $250 gap is, you can qualify for that. Previously, when the maximum was 25 years, you needed $95,000 of a household income to afford a $450,000 mortgage. That is, disclaimer is no debt. It's no other balance of credit cards. It's just strictly mortgage that you have. You needed $95,000 worth of income. Whereas if you extend it over 30 years and your payments are lower, you only needed $88,000. So you need less income to qualify for the same size house because we were able to extend it longer and make the payment smaller. So that's where the benefit of the government stepping in and saying, hey, houses are getting a little more expensive. We want it to still be affordable. Let's allow them to go to 30 years. So it requires less income to get into that house. So moving on. Okay, this graph here. So this is a great graph. It's just because it's categorized as these are the programs, these are the benefits, this is the max, and who qualifies. So we had a disclaimer and asterisk down there where, so some of these are first-time home buyers only, first time with the credentials as never owned a home in the last 4 years. Some of these programs are available even if you have like the divorce, like relationship breakdown, can qualify for some, but not all. Some of these are strictly first-time home buyers. Some, when there's a relationship breakdown and they have to restart over again. So I can let you know right now, the FHSA, the tax credit, and the GST rebates, those are strictly first-time home buyers. So that's why when I say to clients who are looking to buy a house, that FHSA, that program is a powerful tool, number one, and it's only allowed one time. One time you're buying your first house, if you co-sign or you've been in a relationship, it's a fallout and you have to buy a house again, you no longer qualify for that. That is strictly. So some of these programs, the relationship breakdown resets you, and some it's no. Once it's a one-time done deal. So that FHSA, powerful tool, utilize that. Next one. Down payment, how much do you need? The common question. For an owner-occupied property, primary residence, when you buy your first home, minimum is 5% down on the first $500,000. So 5%. So the blue, so that blue number. So minimum. So the $25,000 for down payment is 5% on a $500,000 home. Anything above $500,000, the additional is at 10%. So for example, if you're buying a $600,000 property, $25,000 would be the down payment, the 5% on the 500, 10% on the additional $100,000 that you're over that. So on a $600,000 property, it'd be 25 grand plus 10 grand. So $35,000 is the minimum down payment for your first home. And so anything less than 20% down payment requires what's called a government default insurance called CMHC. You're gonna hear a lot of lingo being thrown around in when you're buying a house. Is it insured? CMHC insured, right? So you'll know that it is a government required, no matter what institution you go to, any any bank brand, less than 20% down, it's government mandated that you have this insurance, CMHC, and the premium itself is provided by the lender. They will borrow you the money. You're only required to come from your own pockets, your down payment, closing costs. That's it. The premium that CMHC charges is added on top of your mortgage balance. Your payment, when your broker quotes you a payment on your budget, it is already inclusive if it's less than 20% down. So we have those conversations. So it's all, when you're given that budget or given that a mortgage amount, it's already in there. And the CMHC premiums are costly. They're quite costly. And so you can Google CMHC. It's a government website to see the different premiums. But I can verbally tell you right now that if you're doing the minimum down, 5%, the premiums the more you put down, the less overall cost. On a 5% down, it's 4.2% premium, meaning you start off your home not with 5% equity, but 0.8% equity, because 4.2% of that money has gone to paying CMHC. So when you put 10% down, it's 3.3% premium on the mortgage amount. So you're starting off, again, the cost of that, and that 15% down, it's at 3%. So we suggest more down, but I know as a first-time home buyer, saving up the additional funds can be difficult. And if you wait, your concern is the price of the house gonna, be, increase faster than my saving ability. And there's maximums with the FHSA, there's limitations as well. So a lot of times is to start rebuilding equity, is to just do ideally I say, hey, listen, if you want to pay the CMHC premium, hopefully it's on your first home. You build enough equity so that the next home that you upgrade to, you have the 20% down, so you avoid the CMHC. And that's the goal. That's the goal. Pay the one time, get in, build the equity. Then if you want to upgrade, have 20% down that you've saved up, like you've saved down as you built up, as you paid down your mortgage and the value increases. And now you're no longer going forward, ever going to pay that again. Next slide. We've got to run through these quickly. Mortgages and pre-approval. Okay. So the first step before you buy a house, talk to the person that is going to give you a budget, the money. We're going to go through all the due diligence of what do you need to be able, before we send you out shopping and have your heart set on a property, before you fall in love, we got to do the due diligence to make sure that you're able to say yes and not be heartbroken. So the pre-approval, there's when we get you a mortgage, it is set up in your mortgage payments. The type of the rate that you're getting, and how that rate in the term that so the contract time that your mortgage is, the interest rate, is your payment locked in or not? There's two ways that you can set it up. It's a choice. The fixed rate is you can decide, hey, you know what, I'll take and this is very common when it's like anyone who has paid a bill for power. You can go fixed with power, or you can go variable with power. The same thing. Variable is a floating rate, or you can do a fixed, guaranteed that during that contract time, it's the same payment. This is the same with the mortgage. That mortgage of yours for the next 5 years, is that payment going to be the same? You lock it in. It never changes. It allows you to budget. Where the drawback is, it's slightly higher than variable. Variable historically because it's going up and down, it's floating, has been long-term, has saved you more money, and it's easier to break. There's certain things where we do suggest anyone who's an investor to do it on variable, because it carries the lowest penalty when you have to exit. It has more flexibility for the variable. But that being said, the fixed rate has a guarantee, but you pay for that guarantee. Higher rate, and the penalty to break is higher. Variable interest rate, it's risky, it floats. Benefit, it saves you money, but there's no predictability. And I always tell clients, first-time home buyer, your mortgage is a 25, 30-year plan here. It's a long game. And the first 5 years of owning a home, let's not, I would like to put you into a mortgage rate product that gives you more guarantee, because it's your first time own home. Like you're buying, this is a new milestone, a new phase of your life. You have 30 years of this long game. Let's start the first 5 years doing fixed so you can get your budgeting. There's a lot of expenses going into buying a house, right? So I feel like I tell clients, let's just lock in and guarantee the rate for the first 5 years. Once you're settled in, you're going to have the opportunity to renew or renegotiate your mortgage, because over the 30 years, once the contract time is up, the 5 year is up, we can renegotiate and switch you to a variable rate the next term. So into the next 5 years, then do variable, give that a try and see how that works out. And that typically is how I advise clients on which product is more suitable. So it's not for everyone. So it's a discussion we'll have to talk about. How do we set up your mortgage and that payment and what it looks like, and if you guarantee it, or we're gonna risk it. Next slide.
Yeah, and it highly depends on your income too, right? If you're making really good money, you might not need to max out your mortgage, right? So, you could be qualified for 500, but it's only you, and you don't need a $500,000 house. So you're probably looking at that 350, 400. So you might have a little bit of room for that, fluctuation. So
you
depends.
can. Yeah. Get pre-approved in Alberta. Okay, so what happens at the pre-approval stage? So before you go shopping, let's do the due diligence pre-approval stage. Check your credit, which I will do. Gather the documents. I am looking for two type documents on confirming two things: your down payment and your income. How do I confirm how much income to figure out your budget? Your size of your mortgage, the house that you can buy, is directly affected by how much you make, how much liabilities, so debt you carry, and then what's left over. Income documents will give me your budget. The down payment statements will show me that are the funds in your account and how they've come in. Will they qualify for the lender to say, yeah, this is the source of the down payment. These are all legitimate sources. Okay. And obviously the ID. Calculating your budget, I do the calculations. The word stress test is going to come out. You're going to hear it, but it's something you never have to worry about. You're not computing stress tests. We mortgage brokers will compute stress tests, but just you be aware, when we're qualifying you, we are qualifying you on a rate that is higher, because if rates go up, at least we know we've qualified you to be able to afford a higher interest rate. Theoretically, this is a mathematical, calculation. It's government's requirement to just help buffer. If rates do go up, they're based on their calculations, you should theoretically afford it. And then the number 4, like I said, a mortgage broker like myself, we can compare. I have the ability with TMG, get a list every single morning and say, hey, who's got the promotional rates, who's got the lowest rates, right? And so then I can do all that shopping for you. And right now, so that list it's extensive, and there's always lenders that want to lend. And so it's just a matter of we choosing the top ones are the easy and have the best rates. And then get a pre-approval letter. Once you're done doing the due diligence, we do the pre-approval process. I give you a letter. If we're in an increasing rate market, I'll lock in a rate for you so that while you're shopping, your rate is guaranteed for up to 130 days so that you can shop and not be worried about rates going up. Because once I give you a locked rate, if it goes up, you're protected. That's your maximum ceiling. Rates go down before you put in an offer. Once you have an offer in, we look back and say, hey, our interest rate that we have is locked in for you is high. It's gone down. We submit and apply for the lower interest rate. So there's no drawback. You're either going to get the maximum protection, or, hey, rates have dropped. Let's get you the lower rate. Next slide. How much can you afford? So these are so based on income, like I said, it's the income that directly affects how much you qualify for. So based on income, gross household income, we take everyone's household income, so up to 4 people in the application. So, and then that's before tax. This is what you can qualify for. And where you say, hey, well, when you're looking at your specific income, your household income, and you think, well, it's not enough, maybe you can ask if you're looking at this graph and saying, well, I might have to need a cosigner. So this is either going to say, yes, you can, or I might have to maybe get more income. There's side gigs and opportunities to make more income. And yes, we can use side gig income. There are requirements as to what you have to provide for paperwork and how long you've had that income to sustain that we can. So we can set a custom plan to get you to the price that you want or need. Next slide. Yeah. Okay. So
all right, now,
because once you're pre-approved with me and it said, hey, you're locked in, this is your budget, I say the fun part starts. I hand you off to Kathy.
All right. So Cheetah's going to help you build your credit. She's going to give you the best ways to save up for a down payment. And then once you're ready to start, then she gets your pre-approval. And then that's when you talk to me and we go through your needs and wants, the areas in Edmonton and surrounding areas where you'd like to live. And then when we find a house, I give you back to Cheetah to get your final approval for this house. So this is why, we get a pre-approval that isn't 100% guaranteed. It's just a soft approval, and then we have to look at the house to get your final approval. Okay, and then once we get that approval, then we'll go through some of the inspection items, maybe renegotiate and all that stuff. So again, we look at your needs versus wants, and everybody wants that beautiful home, but you got to understand that this is your first home. It's not your forever home. So we don't need something that is perfect. Okay, we want something just to get into the market so we're not wasting our money renting. So I will go through this with you, and if you have the ability to, if you have time, or if you're married to somebody handy, it's a great way to get in the market and maybe do some work on the house and build up some sweat equity. But everybody's different. So, part of the buyer consultation, we'll go through that and I'll ask you some qualifying questions, which will help me determine, hey, which type of home that I would recommend. And we kind of look at some options and we narrow down exactly what you'll be looking for. So choosing an agent to work with you, it really is can make or break it, because if you go with an agent that doesn't really understand what you're looking for or isn't very experienced, then it's going to make the process a little bit harder. Okay. Now, when we're searching for homes, I like to give you a bit of a variety, because it's your first time. You haven't had a whole lot of experience in looking at homes, what to look for. So, you might have an idea, but oftentimes I find my first-time home buyers going in a completely different direction with what they actually thought they wanted, based on what they see in the market. So don't be too quick and don't be too narrow-minded when you're looking at your first home. Again, it's not going to be your forever home. A lot of first-time home buyers, it could be 3 to 5 years before you move to your next home, because life changes when you're in your 20s or 30s. Life changes pretty quick. Now, once you find your home, we make an offer, and this offer is going to be based on my market research on what I think the value of the home will be. Right now, it's a really great time to be buying, because it is a balanced to buyer's market. So that is when buyers want to get into the market. When it's a seller's market, that's when we see a lot of multiple offers and the prices just go up every month. So as a buyer, first-time home buyer especially, right, this type of market, a buyer's market, is where you want to get into the market. Okay. So we write an offer based on those findings. And this offer will most of the times include 2, maybe 3 conditions, but the 2 must-haves are financing and inspection, right? We want to make sure that the bank will qualify you for it. And once we get the okay from your mortgage broker, then we go ahead and do a home inspection. A home inspection is never going to be a clean report. There's always going to be a whole bunch of maintenance items on there, and we're not looking for cosmetic issues. We're looking for big ticket items. Maybe there's a leak in the roof that maybe even the homeowner didn't know. If there's plumbing or electrical issues, we want to make sure that we get to that, get ahead of that and correct that problem right away. Things that could be costly. I usually say, anything over $2,000, we might want to either renegotiate or have sellers correct that problem before it becomes a bigger issue. So every offer, every inspection is going to look a little different, but I'll go through it with you. With the experience that I've had, there's almost nothing that surprises me anymore. And then before we even make an offer, we also want to have a good look at the home inside and outside so that we can determine, things that we can see if we're going to need to replace the shingles, soon. Soon meaning we can see the shingles curl, and that probably means like at maximum, 3 to 5 years maximum.
Shingles are expensive.
Okay, along with other things. What was that, Cheetah?
Replacing a roof is very expensive. Some big ticket items are replacing roof, furnace, hot water tank. Those are big items. Those are definitely, that's what you're looking for, not paint chips.
Those, for the most part, that is what we're looking for. So look at the furnace, hot water tank, maybe even windows if we're looking at a really old home. And one really big thing that is easily corrected is the slopage around your home. Is your landscaping slope towards the house, or is it going to be, directing water away from the house? Very easy fix, but we want to make sure that we're thinking about that. Okay. And then once we're done with inspections, we've got all those major things worked out, then sale is final. Okay. What's included in the offer? Okay, this sometimes people don't understand. Are these appliances included? Yep. Because for home to work, you need some appliances. Typically, anything that is screwed into the walls should be included. So blinds most of the times, because they're custom to that specific window, right? Garage openers, sheds. Sometimes, we want to include items that aren't typically included, but we can say, hey, we really like that kids swing set in the backyard. Can we include that? Yep. You can ask for anything, whether the seller wants to accept it or not. That's part of the negotiations, right? You can ask for the world, but we just have to come together and agree on something. And a lot of times, especially if somebody's downsizing, they might not want to take everything. So we got options. Sometimes if you're looking at, say, a small bungalow where the homeowner has been there for 20, 30 years and they're downsizing, they got to get rid of the stuff anyway. So those are great places to pick up, because a lot of times those homes are very well kept. Even though they're a little bit dated, they're very well kept. Obviously, we'll have the price included and possession date. Possession date is typically about 45 days from the date of offer, okay? And it can range. There's no set timeline. It could be 2 weeks. It could be 3 to 6 months, right? But the most common would be 45 days. Your deposit, okay? Whenever you submit an offer, it also comes with a deposit. So this deposit is based on your purchase price. So at the low end, I always say about $5,000, and all the way up to about $20,000, but based on purchase price. So this deposit, as soon as they accept an offer, we have typically 2 days to provide them with a deposit, and this solidifies your purchase during that pending period. Okay, and that pending period is typically about 2 weeks or 5 to 10 business days to satisfy the conditions of financing, inspection, and if it's a condo, also condo review. Okay, so those are the 3 typical conditions that we put onto pretty much every offer. Now, again, I will do the research on recent solds so that you know that you're not overpaying. And if you're overpaying, you know that you're overpaying. So depending on the type of market, again, if it's a seller's market, you're going to be overpaying. So what I tell you is, here's what I think the value is. How much more is this home worth to you? And that's the offer that we put in. Okay. There's always room for negotiations. So typically we can make an offer, the sellers can counter, and we might go back and forth a few times, okay, until we come to a middle ground, okay? And again, we can request for repairs or price reductions, depending on what it is. There's certain things where I would say, wait till you take possession so that you know how it's being done. You are hiring the trade, because if left to a seller, they're going to hire the cheapest trade, and it's very hard to put into words, the quality of finish on a repair. So things like plumbing and electrical, hey, we want that done as soon as possible. But there's other things where it might be cosmetic, or it's not going to make it or break it. Then I would say take a little bit of a price reduction, and you hire your own trade to do the repair. And in negotiations, I'm always making sure that your budget is private. There's no way I would be sharing that. Part of negotiations is, for if I'm representing a buyer, is to keep the price as low as possible. If I'm representing a seller, then I want as much as possible, right? So you never want to give that away. Okay. So what's it going to cost to purchase a home? So we don't have a land transfer fee, but there is a land title fee to register a new title, and a mortgage registration fee. So that could run you up to $2,000-ish on average. But as a starter home, it's probably going to be on the lower end, about $700 in this case, based on like a $400,000 purchase price. Your real estate lawyer fee will run about $1,400 to $1,800, depending on the type of home, the mortgage, and then title insurance. Title insurance protects you against any fraudulent transactions. So and unknown liens. We can pull the title of the property when we transact, but if there's something that kind of gets in there before title is transferred, which makes it unloaned, then title insurance would take care of that. And this is typically between $250 and $350. And the lawyer will take care of this at closing with you. Property tax adjustment. This is one thing that a lot of people forget to include when they're purchasing their home. So for this year, I'm finding that property taxes are approximately 1% of your purchase price, give or take. Okay, so if and property taxes are due at the end of June. each year. So if you're buying at the beginning of the year, like the first half of the year, then the homeowner may not have paid for that year yet. And so then you're going to get you're going to have to pay that, and the homeowner will have to credit you the portion of that year up until your possession date. Okay, if you're at the buying at the second half of the year, then the seller would have or should have already paid for the year, and so you are responsible upfront to pay that. So if it's a $400,000 home, it's going to be roughly $2,000. Okay, so that you're going to have to come up with that upfront before we purchase the home. Okay. Home inspection, you're looking at anywhere from $450 to $800. Typically, you're probably looking at around that $500 mark. Okay. Again, CMHC premiums, as Sheeta has mentioned, which will be tagged onto your mortgage at 2.8 to 4.2%. And then there's also home insurance. Okay, home insurance will be roughly $1,200 to $2,800. And before you meet with your lawyer, they will make sure that you have your home insurance set up. So during this pending period, when you're getting your financing and home inspection, it's also a good idea to start calling for home insurance quotes as well. All right. I got a question here. Land transfer to purchase a house in the middle of the year. That land transfer fee doesn't matter when you buy. If you buy a house in the middle of the year, who pays that?
Oh.
Okay, so I guess I've addressed that. So the land transfer fee, registration fee, that doesn't matter when you buy. It's the property tax that would be prorated. Okay.
I think the
Now,
question pertains to property taxes. Yeah.
Okay, perfect. Answered. Okay. So before possession date, okay, the lawyer will tell you how much of a check to bring in, and that check will include the balance of your down payment. So again, when they accepted an offer, you've already paid them a deposit. So that deposit forms part of your down payment. And so that will be subtracted. But this bank draft will include the balance of your mortgage payment, down payment, your closing fees, which will be estimated with the lawyer fees, and the lawyer will add on a little bit of a buffer, and whatever is left over after everything is paid out, then you get a check, a refund check. Okay. Depending on if the property was like rental property, a lot of times with rental properties, we don't know what condition the home will be at on possession day. So I would request in those cases to do a walkthrough, at least a day or two before, so that we make sure that anything that needs to be cleared out is done, and it doesn't delay possession. So when we're walking through, if that home shows really well, we know we're probably not going to have an issue. But if there was a tenant who might have been a little bit of a hoarder, hey, we probably want to make sure that everything's cleared out before we hand them over the money. Okay. You also want to make sure that you hook up your utilities. Okay. Don't do this last minute. And then get obviously your home insurance will be effective the date of possession day. You'll also make sure you need to bring valid ID to the lawyer's office. and review the statement of adjustments with your lawyer. So go through that the list of the costs on that with the lawyer to make sure that you're not even being overcharged, or they're humans doing this, so there could be some mistakes. I've caught, I think in my lifetime, only 3 cases where my clients were like, well, this doesn't look right, can you have a second look? And yeah, they were overcharged on some things, but it was human error. Okay, now after you get keys to your new home, first thing you want to do is change the locks. Very easy to do. And if you're lucky enough to have one of those locks that you can rekey, oh, even better. It'll save you so much money. You want to make sure that you document the existing, when you take possession, take some quick photos and videos just so that you're aware of anything that's questionable, or you see it the next day and you're like, who dinged this up? Was it like this? It could have been you guys. Also, make sure that you register for your property taxes. If it's not already included with your mortgage payments, which I personally prefer, so I don't have to think about it, one less payment. If you haven't done that, included it with your mortgage payment, then make sure that you have it set up to either monthly payment or annual payment. Okay. And of course, get out, meet your neighbors. It's really nice to be moved in and, get to know your neighbors just in case you need something or they need something. Always nice to build a community around you. Okay. And then obviously now you own the home, and any maintenance costs, it's you. So make sure that you have a savings for that. And we recommend about 1% of your purchase price per year saved up, either set aside or whatever, for that emergency fund. And then celebrate that you're a homeowner. Okay. Now, we want to make sure that you are aware of the 10 big mistakes first-time homeowner, so we can avoid these mistakes. That would be great. Obviously, this is a new one, the not opening up your FHSA immediately. I've got an 18-year-old. We're going to have to start getting that account open so that she has room. Skipping the home inspection in a bidding war. As a first-time home buyer, I would say let's try our best to avoid this, but it's very situational. But as a first-time home buyer, I would say this is one thing that we should not skip, is the home inspection. Okay, making large purchases. Cheetah has talked about this. Do not make any big purchases. Do not rack up your credit card before I hand you the keys to your new home. After you purchase your home, after you get the keys, after you unlock the door, do whatever you want. But not before. Okay. And if there are certain situations where like, can I not, ask Cheetah? Okay. For closing costs, make sure that you understand what the closing costs are. I would say at a very minimum, have $5,000 for closing costs. Okay. Wanting everything and not compromising. Again, this is not your forever home. This is just for you to get into the market, start building equity, start your first savings account, and then you can move up later on. Getting a pre-approval as soon as you're ready, before we even start looking at homes, because what we've seen in the market is if you don't have a pre-approval, your offer might not even get looked at. So if we're in a situation where we're in multiple offers, you don't have pre-approval, I'm sorry, our offer is probably not going to be considered. Okay. So have that pre-approval letter ready to go when we have an offer ready to be put out. Buying at the very top of your budget, as a first-time home buyer, you're probably working with a smaller budget. If we have to max that out, it could be very stressful. So I do recommend, if we can, go with something a little bit more affordable. So I always ask you, what are you approved for? What are you comfortable paying? Okay, so I try not to max out our budget, and that helps with, making sure that we set our expectations at the beginning. Don't start shopping before you get your pre-approval. That's a huge, huge mistake that I've seen time and time again, because you're thinking, oh, I can afford a $500,000 home, so I'm going to start looking at that price range, and then you go get your pre-approval and Cheetah says, you've got some debt here that's going to bring your income down, and you're really only qualified for 350 or 400. Okay, and now it's really hard to bring that expectation down. So make sure you get a pre-approval first, and then we'll go make your list, and I will go through and set you up on the right search criteria. Okay, changing jobs in the middle of your application. If you're changing jobs within the same field, that's fine. But if it's a completely different industry, we're going to have a problem, and you're not going to qualify for your mortgage. So even though you have a pre-approval,
that's right.
If things change between the time of your pre-approval and your possession date, that can all be taken away. Okay, so no big purchases, no big job changes into a different industry. If you're looking to move up in your own same industry, hey, absolutely. Yeah. And not asking about the GST rebate on a new construction. Obviously, this is only going to apply to new homes. So, and that rebate can be credited to you up front or after you purchase the home. And most of the times it's going to be after you purchase the home, because you have to qualify. You have to submit documents, and the government has to make sure you qualify before you get that rebate. Okay. And not reaching out to your mortgage broker and realtor sooner to create a custom plan. Start today. Start talking to Cheetah today to get that game plan going. Okay. And again, don't worry about, hey, we're wasting, I don't want to waste your time. Don't worry about that. This is what we do all day long. And we love educating our clients. We love being there at the beginning and then taking you all the way through to the end. Okay. So, for those that are looking to buy maybe next year, here is your 12-month action plan. Open your FHSA. I don't know how many times we've said this, but obviously it is our number one most effective product to help you build your down payment faster, because that savings that you're getting, and then the tax-free savings that when you're taking it out is huge. Okay, so if you're say putting in $8,000, that's 15%. Say you're in the lowest tax bracket. What's the lowest tax bracket? What, 12-15%? That's how much basically your return on investment is, right? Plus whatever you're gaining in that during that time that your money is growing in that investment. Okay. 3 to 4 months, pay down credit card balances. Make sure that you're looking at your credit report and dispute any errors that you see on it. Okay. 5 to 7 months, gather all your T-slips, pay stubs, and everything, and get your, maybe a soft pre-approval, not a hard pull on credit. Do a check-in with Cheetah, okay? And then 8 to 10 months, we're looking at what your options are in what type of home that you're looking at. And then 11 to 12, hey, we're actively looking at a home and we're writing offers. Okay. All right. How does it work if a new job is started but the other applicant is at the same one? Does that still apply? Cheetah?
So the answer is it's so the one with the same, if you originally were on the application, if you're on the application means that your credit is good and you're now, I'm taking your income on the application. The one that has the same job, nothing's changed on that. If you're starting a new job, you're on my application and you're starting, you switch jobs, you come back to me. So any changes from the original pre-approval, you come to me to make sure that, is that job change still allowed? Is that income still allowed on the application? If it still qualifies, I say continue with continue looking, or wherever you're in the process. If that new job no longer qualifies, so oftentimes it's like I have a client who goes from an employed status to a self-employed status, or something's contract, you don't apply anymore. That income I can't use. So the question remains now, I have to remove that person's entire profile and income from the application. So we're qualifying only on one income now. So that changes everything. So it's very important in the pre-approval stage. And you saw the progress map of you work with me. Then once we get the pre-approval, I send you Kathy to go shopping. You come back to me during the financing approval period. So the pre-approval is just to say, hey, this is your budget. I'm running all your paperwork. I'm checking. This is what you are qualified for. Any changes that happen before we hit the approval, because the approval happens is when you put an offer, you submit an offer with Kathy, you come back to me with the housing detail, the house that you've put an offer on, plus the application, which the information I have on you, your income, your down payment, that is submitted to the lender. Now the lender has the full review in that approval period, that pending period, which is typically, 10 days. In that period, anything that changes from the pre-approval stage to where we are now, it changes everything. I can no longer use your income. I can no longer, so right there, it would be disqualified. That's why the pre-approval is important. Any changes happen before we submit the offer, because once we hit that approval stage, it has to mirror, or if it doesn't mirror, is the new information still applicable or can still qualify? And so that's where it's really important when you have any changes to credit, purchasing, income changes, all that has to be, it's the conversation between myself and my clients. There's no such thing as over communicating in this very crucial time period between pre-approval to getting your keys, and however long that is. No such thing as over communicating. Under communication leads to failure or just disappointment, not being approved. So success happens when lots of communication. Any changes happen, running by me. If it's something that you had no control over, you were let go. Okay, well, in that point, we gotta retract, right? Like I gotta step back, get you back to a different employment, and then with the new employment secured, then we can get you out shopping again. So so then I'm guiding you in that way when things do change. We just have to pivot. So does that answer your question? I think that does. So going back to the property tax question, I want to reiterate with what Kathy said. So it is your responsibility then if you are going to buy a home and you're now going to be the new homeowner, it is your responsibility for your portion of the property tax for for your portion of the year. If you move in right after the June 30th, where the seller has paid the bill for the calendar year of January 1st to December 31st, and let's say you take possession in the middle of August, so August 15th, the seller has already paid the property tax bill. and this property tax bill for up until December 31st. You occupy it from August 15th to December 31st of that year. You are required, it is your responsibility, and this is calculated at the lawyer's office. They calculate your property tax to the day. That how many days of the calendar year of your portion of the property tax. That's why what the closing cost is important, that you're reading through the ledger that the accountant gives you. It'll show you how many days that you're responsible for that year that the seller's already paid and you have to reimburse, and you bring that money into the office, and that is your responsibility. The lender will lend you money on the CMHC premium and the mortgage, but down payment, closing costs is your responsibility, and that property tax is your responsibility. So that's why budgeting is very important. It's better to over budget, because sometimes you are up for half that year of property tax. It's very real.
Yeah, and that's the maximum that you'd be responsible for is half a year.
Typically half.
Okay, so yeah.
Because it's due June 30th of every single year, because it's due in the middle of the year. So depending on whether, if the seller hadn't paid yet, right? And you buy in May. Well, the bill wasn't due until June 30th, but so now the seller has to give you from January 1st until their possession date. So you save that money, because you get that money back from the lawyer's office. You save that money and you make sure that goes towards the bill for that year that's due June 30th.
Yeah, you make sure you don't spend that money that you're saving, because you will be responsible for the full year payment on June 30th. Okay, so yeah. Okay. If you have any further questions, feel free to contact Cheetah or myself, and we'd be happy to, go into your specifics with you and get you started, whether you're looking to buy now or next year or in the next 15 years.
True.
Get started today. Okay?
No such thing as over communicating, and there's no such thing as too early. No such thing. We can do a pre-approval and postpone for years and years and years and years. It still doesn't matter. The mistakes are always your backtracking. You go in without a pre-approval, or you haven't disclosed, or you forgot to disclose, or we didn't have a conversation and we just assumed that we assume, I assume, and as a broker mistake, because I've been doing this for so long, assume the clients know it's a general information. But I have to remember it's a general information for me, because I've been in this industry, that I got to put myself in the shoes of a person from the very get. That's mortgage 101, right? So seamless communication, no such things over communicate, because otherwise, like, mistakes happen when there's information isn't disclosed or discussed.
Okay. Thank you so much for joining us. Thank you for your questions. We went way overboard today, but that's okay. If you need to go back, it's going to be there on YouTube for you. But we do recommend to talk to us early on and get you started. And Cheetah will even be able to give you a plan if you're going, okay, when's the earliest I could buy? She'll be able to give you a game plan, 1 year, 2 years, 3 years. Okay?
Never too early.
And I get to do the fun parts. The shopping. We love shopping. Okay. All right. So thank you again for joining us, and see you soon. Bye.
Have a good weekend.